to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Kinna Patel, Head of Investment Proposition at NatWest Cushon, to the show. Welcome, Kinna.
Hi Charlotte, great to be here.
Well, I think we're both really pleased to be here, given all the technical difficulties we've just been through.
Yes, that too.
And there's one advantage, it gets you very relaxed. And welcome to everybody's December Professional Investment Podcast with a little red Christmas tree in the corner, just in case you weren't aware that we're in the rundown to Christmas. But do tell us, Kinna, what is your news story of the week?
Sure, my story of the week is from the Financial Times and it's titled Salary Sacrifice Shake-Up, What It Means for Staff and Employers.
And I do wonder, why did you choose this as your news story of the week, given that we had the budget last week?
Well, yeah, so as expected, the budget announcement, and rightly so, has, especially around salary sacrifice, has dominated pension headlines this week. So it seemed quite fitting for this article to feature for this podcast.
Indeed. And I do think it is fitting, and it is kind of, you know, the budget was kind of the dog that didn't bark, and that everybody's expecting it to be radical and it wasn't. But it does seem a bit odd, doesn't it, to include something that stops people from actually adding to their pensions when at the same time you have this massive pension scheme bill going through Parliament, and this government has revivified the Pensions Commission to look at pensions adequacy. So it seems strange on the one hand to be wanting to look at pensions adequacy, and on the other hand preventing people from adding additionally to their pension through salary sacrifice.
Yeah, and you know, it's just that, look, on the face of it, I think there was a lot of speculation in the run-up to the budget, and I do think, dare I say, for pensions it could have been a lot worse. But in terms of salary sacrifice or salary exchange, which is my preferred term as it is a little bit more friendlier, we obviously would have preferred to have no change here, because clearly, as you mentioned, it will reduce pension values. Because it's odd, because given the new pensions commission that's in place to look at adequacy, it just seems that this is going to affect that. And I think one of the fears that I have is that this change has the potential to affect confidence in pensions and to effectively undermine it. So in essence, we will continue to lobby against that change. But I mean, it's not all doom and gloom. So even though it's not great, it's not all doom and gloom, because for those employers who already offer pension salary sacrifice or salary exchange, it's business as usual effectively for the next 3 years, because nothing changes, nothing needs to be done. This isn't coming into effect until 2029. And for those who don't yet offer salary sacrifice, and I guess the question is simply why not? Because despite all the negative headlines we've seen, the £2,000 cap, if we assume a 5% employee contribution, equates to around £40,000 a year salary. So up to this salary level, for savings for both employers and employees actually remain the same. Nothing changes even post 2029. And from 2029, for those employees whose salaries are higher, salary sacrifice will still offer great savings, but just not the same as it used to. And I think that's an important message, especially for those companies that aren't yet utilising salary sacrifice, for this to not get lost in all of the noise. But I do agree that in terms of confidence and pensions adequacy is something that will need to be looked at. And, you know, 2029 is still a while away, so a lot could actually change.
Yes, indeed, we have got plenty of time for things to be rolled back. But to pick up on that, I mean, we mentioned that the Pensions Commission has been revivified with the purpose of addressing pensions adequacy. And we know that DC contribution levels are much lower than they were in DB at 8%. DB were somewhere between 20 to 24. And most people in the industry think that contribution levels should be doubled up to 16%. But the government has said that it's not going to do anything around contribution levels until the next Parliament, assuming it gets in the next Parliament. So I guess in a way that's putting more pressure on people like you, Kinna, who are looking at that whole investment conundrum and have to actually make sure that your members are getting the maximum bang for their buck in terms of investment concern, without obviously taking on so much risk that it becomes detrimental to your members. Can you talk to us a bit about how you do that in terms of the lifetime of the member, what assets you're using, and how you shift that journey?
Yeah, of course. So, look, I agree with you in terms of it could mean additional pressure to maximize investment returns. However, I think as providers, we essentially need to ensure that risk is being taken on at the right time of a lifestyle strategy or a glide path. So members who have a number of years before their selected retirement age can afford to take on that additional risk because their time horizon to retirement is longer. They do have regular contributions in, albeit it might not be to the amount, the percentage that we want it to be, but effectively until they access their pot, all of this should actually smooth out any short-term volatility. And then I think next what also needs to be considered is when we actually decide to de-risk our members. So de-risk is when you're effectively coming out of those growth assets and going into more defensive ones, and you do it too late, say 2 or 3 years from retirement, it could have adverse effects on pot sizes if markets were to fall. And if you de-risk too early, then members actually may miss out on years of potential growth and compounding. So it's a fine balance. And, outside of that, I think it's important for us to develop an investment strategy that takes into account different types of risks. And, low contribution rates are another risk that we need to be mindful of. But it needs to be one that utilizes a range of asset classes to take advantage of different investment opportunities. So we need to continuously innovate to make sure we're doing the best we possibly can for members.
And so, of those asset classes, there are 3 obvious building blocks: there's equity, fixed income, and private assets. Let's take each of those in turns. Let's start with equities. Obviously, that's going to be a key driver for wealth over the long term, because we know that equities is very good at providing wealth over the long term, if volatile over the short term. And obviously, it's a very cost-efficient way of getting that incremental wealth for scheme members. So talk to me about how you approach equities in your portfolio.
Yeah, of course. And as you said, arguably these have the greatest importance because they're utilized across the entire glide path. In the growth stage, across providers, they make up the bulk of the allocation. Now I'm talking anywhere between 75 to 100%. And the pre-retirement phases, we're looking at on average around 30% in allocation. And that's, even some defaults, that's actually higher. And given that DC is still so young, they used to have DB pensions, so the majority of members are still invested in the growth stage and in turn have large allocations to equity. So in terms of how to approach this asset class, generally passive is what providers do because there's a large emphasis on cost in DC, and passive equities are relatively quite cheap in terms of fund management charges, but also because it gives you broad market exposure. But there needs to be some considerations around that allocation. So first and foremost, sustainability. Are you excluding certain sectors? If so, what are the expected impacts on your returns for excluding these sectors, and why? Is there a tilt in place? So are you allocating more money towards those companies that are scoring better on environmental, social, governance factors? Is it worth maybe considering just climate, for example? So investing more in companies with stronger green revenues that are more climate friendly and less in the ones that aren't? Do we also need to consider stuff like multi-factor and looking at quality, momentum, value, and so forth as well? It's also important to see that do we want to consider part of the allocation to be actively managed to gain some alpha generation? And then in tandem, how does that also impact cost and your expected levels of risk and return? And then if you are sticking with the passive approach, you need to consider sort of regional and sector biases. So when you do have a market cap approach, a significant proportion of your allocation is invested in the US and tech. because Mag 7, dominates so much. So the approach needs to take this into account. And some providers think about these biases and they allocate different percentages to each region to try to reduce that concentration risk. And then some don't. Why some don't is because market cap effectively represents the consensus market view. It's also more tax and cost efficient, and you're avoiding systematic betting because you're not trying to bet on which region's going to outperform. And then outside of that, and something that's quite linked to sort of the different regions that you invest in, is currency. And currency is something that should also be looked at, because in times of big crises, as we've seen, currency often moves sharply. So hedging can actually cushion these FX driven losses. And, we've seen that come up time and time again.
Yeah, I mean, there's lots of different options there within equities. You can take the plain vanilla approach, you can take a climate tilt approach, you can start waiting for different regions, you can add some alpha, you can add some hedging. Of all of those options, where are you currently thinking about? Where are you on that spectrum?
Yep, so all of our equity allocation is passively allocated. It is does have some exclusions in place and a climate tilt as well. So we are allocating more to those companies that are deemed more climate friendly. Currency hedging is something that we are looking into, and hopefully should have more information on that shortly.
Okay, and what about the regional, being able to dynamically allocate between different regions? That's not something you're yet considering?
No, we just deploy a market cap approach.
Okay, great. Well, that's equities. Let's move on to fixed income. So thanks to Liz Truss and inflation, it's now an investable asset class again. Yay! But that has an important role to play within a scheme member's portfolio, particularly later on in life. Is that where you see the role, or is there any opportunity to use fixed income earlier on in the member's journey?
I think it depends. So we currently have a small allocation to fixed income earlier on in the journey, just to provide that level of volatility management, and some additional sort of ESG credentials as well. But I think it's important to note that fixed income is such a broad asset class, and it's made up of so many different things that behave very differently. So, for example, UK gilts behave very differently to high yield bonds, to emerging market debt, and so forth. And some fixed income asset classes do have more of a growthy approach, whereas others don't. And I think for providers and also us, and sort of how we think about that, is again best seeing how these different asset classes can be utilized within each sort of stage of the glide path. Traditionally, bonds have been used to provide that level of cushioning when equity markets have fallen. But in recent years, we've seen that as equity markets have fallen, bonds have also fallen. So it's important to consider how to use diversification within that sort of broad asset class, because no one wants to put all of their eggs in one basket. Different fixed income asset classes behave differently year on year. So it's important to consider the whole spectrum. And when I say the whole spectrum, I also mean the private side as well. So it's important to consider both public bonds and private bonds as well. And even when you do that, credentials like sustainability, for example, regional biases, that again comes into play for the fixed income piece as well.
Yeah, that's very interesting. And so that fixed income piece is providing that stability at the end of scheme members' life. But to switch back to something more growthy, maybe, or not necessarily. I mean, private assets has been the talk of pensions land for the past sort of 2 years. And we've seen a government take quite an interventionist agenda and wanting to push people towards investing in UK private assets. How do you approach that? I mean, we've talked with Veronica before, a few series ago, about the infamous pepper farm that you have. How are you thinking about how you approach private assets?
Yeah, so I mean, the pep farm, I've actually been to visit it, and it's quite remarkable, but more to come on that. But in terms of sort of private markets, again, and you've hit the nail right on the head, that it is the growth asset class that us and other providers have looked at or are looking at, for example. So we currently have a 15% allocation to private markets in Cushon's sustainable investment strategy. And the reason for that is because it is believed to provide higher expected returns compared to their listed counterparts, because private market assets provide that illiquidity premium, but also because it is so uncorrelated with traditional asset classes. And I mentioned earlier that traditionally bonds and fixed income were used to provide that sort of cushioning and diversification. But we've seen in sort of various different types of downturns that bonds haven't held up as much as historically they have done. So private market assets, because again, it's so broad. I mean, we have, private equity. Within that, you have growth equity and venture capital. You have infrastructure, real estate, private credit. Because there are so many different types of asset classes, it can be used in such a great way to be able to provide that growth, provide that risk management that we're looking for, or even for in those later stages of the glide path, utilising something like private credit to have that yield pickup over traditional fixed income, but also that diversification too. So it does need to be considered in a sort of very unique way. And I think what you'll have to do is all of these different asset classes need to be considered separately, but also in tandem with each other, depending on the level of risk and return characteristics you're targeting across the glide path, and also how do these marry up to your individual sustainability objectives, something which I know that is very important to us here at Cushon.
You are right. That's a really interesting point. It's about looking at what each asset class can give you individually and then seeing how they all work together, because you don't want to inadvertently have introduced a whole load of correlation risk without even knowing about it.
Yeah, exactly that.
So as we the other really, really big thing that's happening in DC at the moment, obviously, and you and I have talked about it before, is the opportunity that retirement income provides. And we're going through this extraordinary phase where we're really getting to the stage where DC can be equal to DB. I know some people will say equal in air quotes, because some people believe it will never be equal to DB. But by that I mean that it is a wealth creation pot for members, and then also a wealth spending opportunity as they hit retirement and go through retirement. From an investment perspective, as you think about building those retirement income portfolios, do you need new asset classes, or is it just about the mix? Is this the point? We've talked about fixed income providing the that very good ballast and making sure that you don't lose too much value on your DC pot as you approach retirement. As you move to and through retirement, does fixed income become a much more important vehicle to make sure that members are then able to extract their wealth in a way that's going to last them for their lifetime and give them a decent income?
That's a really good question. And no, I don't think so. I think, again, the emphasis would be on growth assets, just because you effectively want that growth for longer if we're talking about a to and through solution. I mean, if someone's going to retire at age 65, you want their pot to effectively last hopefully another 20 years or so. So I think there needs to be significant, I think is a better word, allocation to growth assets to really provide meaningful benefits and to ensure that members don't actually run out of money in retirement. I agree with your point in terms of the mix of asset classes needs to be looked at. And in all honesty, I think that would depend provider to provider. We all allocate to very different things. Some allocate to some asset classes that others don't. So I think it's unfair to say that, we might need to look for new asset classes, but it's more sort of just making sure the entire universe is looked at for each and every asset class. And, private markets, great if that works for providers, different types of equities, and fixed income as well will have a part to play in that too.
Yeah, and I mean, I mean, there's obviously your bit, the investment proposition. There's a kind of like a retirement proposition that almost sort of sits on top of you, so to speak, I might say. But so when it comes to thinking about the longevity risk, is that something that you get involved in too, or does that sort of like, are you just looking at the investment proposition bit of the retirement process, and somebody else is thinking about, do I need an annuity to manage my longevity risk, or do you get involved in that too?
No, I get involved in that too, and I think like a lot of like my peers across the industry, retirement is sort of the golden egg that everybody's trying to crack, and it's something that I know, speaking to some of my peers, that everybody is currently focused on and looking at, and I think it's just a matter of time before we start seeing a lot of interesting things come out into play.
Yeah, and do you think those interesting things will all look the same, or do you think we'll see lots of different interesting things?
I think initially we will see some overlap in ideas. And I think as the DC population starts to age more and we start to see larger pot sizes, because at the moment pot sizes are generally quite low, just given that some members that are retiring now also have historic DB pensions, it's very difficult in terms of sort of innovating within those solutions. But as we start to see pot sizes grow, I think there's greater scope for more innovation. And, the market's very fast developing. I think we'll be able to see some interesting innovation within terms of asset classes as well.
At the beginning of this conversation, you kind of teased us a little, Kinna, and you said that, we'll be constantly innovating in investment. What are you thinking? Where's the innovation, without like front running anything that you don't want to front run to our audience? What are the kind of things that you consider?
That's a very tricky question, and one that I'm going to respectfully pass on.
Yeah, but I am a journalist. I do have to ask, you see.
No, that does make sense.
To go back to then to maybe the private assets and the pepper farm, can you talk a bit more about, you talked about how you integrate your sustainability into those private assets. Maybe talk a bit more about that.
Yeah, of course. And look, I'm going to give the spiel about the pepper farm because I absolutely love it, and I've tried the peppers from there, and it's great. But so for anyone that's listening that doesn't know, so there's a pepper farm which is by Bury St Edmunds, and it's actually the largest single block greenhouse in the UK. It's absolutely huge, covers about the same size as 20 football pitches, and many of us know growing fruit and veg in the winter months in the UK is extremely, extremely challenging. And to grow fresh vegetables in this particular way actually requires copious amounts of fossil fuel. However, this investment that NatWest Cushon have made actually draws heat generated from a nearby wastewater plant. And by creating these new low carbon agricultural techniques in the UK, we actually take a step towards ensuring that we have reliable supplies for the future, and growing more of our food closer to home actually cuts down on food miles, including the carbon associated with transporting food products, which normally would happen. So, it's a great way that sustainability is sort of weaved into an asset class that is geared to provide high levels of expected return and that risk management that I was talking about earlier. And, there are a lot of examples and stuff that we invest in, like whether that's affordable housing, for example, different solar farms or wind farms. And for me, private markets is not just about the pure investment side. I think it has a much more deeper or multifaceted role to play in DC pensions. And I think the other part of that puzzle is engagement. I mean, things such as, very technical terms, investment jargon, if you will, that the average member doesn't understand, when they see what they're invested in and it's something like a high yield bond and they're like, have no idea what that means. But when they see things such as like affordable housing, or they look outside their window and see communities that they live in are being developed, it's something that resonates with members more, and it's something that will sort of lead them to engage with more because it's something that they're actually interested in and something that's a bit more tangible and sort of more easy to understand. So, so I think private markets play a very, very big role in DC.
Yeah, and I think that's a very good point, because that tangibility and that narrative, it's much easier. Before we kind of went the passive equity route, if you think back 20, 30 years ago when we were still investing in public equities, but on sort of either a thematic basis or stock picking individually, it was much, you had the narrative structure there, but it's much harder to say to your scheme member, oh yes, we invest passively in global equities with a climate tilt. Each of those words are individually understandable to the man in the street, but not all pushed together, right? So it does give you this great ability to create a connection, which I think is often lacking from the world of finance. I mean, I certainly know that one of the things that our producer Ryan and I struggle with every week is, what picture are we going to use for the podcast? Because if you spend a whole time talking about BPA market or insurance or whatever, it's really difficult. And when we interviewed Veronica last time, it's great, we can use peppers in the background, and I think we are going to use peppers in the background. So I just need to, I can see why you enjoy that, because it could really create a connection with the scheme member, as well as obviously bolstering their returns at retirement. But do tell us, what kind of peppers are grown there? Is it chilies? Is it Romano peppers? Is it the big traditional squishy peppers? Or is it all of the above? And are all the colours represented?
So it's actually bell peppers. So red, green, orange, yellow. Unfortunately, no pink, but hopefully one day we'll get there. That could never be a pepper colour. But yeah, no, look, I agree with what you said in terms of it does resonate more with members, and these types of things do have that impact. But I think it's also important to note that outside of returns, private market assets will also help us sometimes reach our climate goals, and that could be investing in private assets that are naturally low carbon assets, for example, such as natural capital. And we actually did work with a law firm called Eversheds earlier this year, and effectively the Cushon Master Trust commissioned Eversheds Sutherland to examine how fiduciary duty can go beyond solely relying on financial returns. And their work emphasises that decisions should take into account a member's standard of living in retirement, not just the size of their pension pot. The majority of members in the UK will retire into the UK, so trustees need to consider their standard of living in retirement, which includes looking at areas such as access to services and infrastructure and flood defences, because this is the impact that we could have a wider impact in investments on the UK economy, environment and society.
Yeah, it's been a fascinating discussion, and I think it's a great place for us to leave it there. Kinna, I just want to say thank you for embracing the Cushon corporate identity so wholeheartedly. I realised halfway through that you're wearing your pink sweater. I'm wearing my Christmas red sweater to match my red Christmas tree. So we're completely themed here today. Thank you for all of those insights and for taking part in the Professional Investment Podcast. Listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, do hit the subscribe button and do interact with us. Take part in the Spotify poll if that's how you're listening. And thank you all for listening.